Hello traders, the title of the video is how to apply the Elliott wave rules precisely. Well, you may be thinking that, Joe, here we are, you're going to record another 1 hour or more video talking about all kind of rules. George, I don't want to watch this tutorial. And I will say to you, please stay with us. There are 3 essential Elliott wave rules that one must know. You may say, George, I already know them, but we're going to dwell on them a bit and explain what one needs to do, especially when we are applying the Elliott wave rules. All right. So the first Elliott wave rule stated that the first Elliott wave should not be cancelled by the second Elliott wave, or the second Elliott wave should not cancel the first wave. The second rule stated that the fourth Elliott wave should not overlap the first wave. And the third rule stated that the third Elliott wave should not be the shortest impulse wave. There are 3 impulsive waves, all right, the first, the third, and the fifth. And the Elliott wave rule stated that the third Elliott wave should not be the shortest impulse wave. So those are the 3 essential Elliott wave rules. And you may say, George, I already know them. And why do I watch? Why should I watch this tutorial? Okay. So, if you want to know why you should watch this tutorial, stay with us and watch it. All right, very simple. So, I come across one example here which I discussed in the earlier video that I posted at 24 Elliott Waves YouTube channel, and it's quite interesting. And traders that do care about becoming more, competent Elliott wave traders will watch the full length of this tutorial. So I'm going to go back to the second rule. All right, let's go back to the second rule. The second rule stated that the fourth Elliott wave should not overlap the first wave. Why? Good. Now, that rule has something to do with the third rule. What is the third rule? The third rule is saying that the third Elliott wave should not be the shortest impulse wave. So which means if you are counting wave, if you want to become an Elliott wave analyst, and you are counting wave and you see something like this, what Elliott wave is saying that, okay, don't call this a multi-wave. Don't call anything like this a multi-wave. Why? Because you can see that the third Elliott wave, in comparison to the first one, is shorter than the first one, is also shorter than the fifth one. So most traders already know this. But practically trading, that's got some implication to do with the second rule. So the third rule is that the third Elliott wave should not be the shortest impulse wave. We all get that. But the second rule is saying to us that, the fourth Elliott wave should not come into the range of the first one. So it shouldn't come below the high of the first wave. Should be shallow. Now, you understand this? If you understand the price structure clearly, it's a beautiful statement. The rules are adding. It's quite harmonious. We can go over it more than 1 hour. So what's happening is that a trend is starting, all right? So at the end of the second wave, because if the second wave did not cancel the first wave, is an invitation to buy. Are you with me? So we have the second wave, 38.2% retracement of the first wave, or the second wave is between the 50% and 61.8% Fibonacci retracement level of the first wave. It's good because it's just a pullback. Now, talking about the momentum and the fuel, we can also check the trading volume during the second wave. So if you have the first wave and the second wave, you have, no demand to sell. So there was a demand to buy. But during the second wave, which is a pullback, there is no demand to buy, which means the price is going down on a low trading volume, no demand to sell during the second wave. And if the second wave did not cancel the first wave, which means preferably is somewhere at 38.2% or between the 50 and the 61.8% Fibonacci retracement level of the first wave, that is a clear-cut invitation to buy the asset, because the first buyers, the first wave is the signature of the bull that have bought the stock during the consolidation before the breakouts. Now, this is the first invitation. All right. So, Elliott wave is, according to the Elliott wave rule, if we have the first invitation, that first invitation should be strong. That's all. This is about the third rule. This first invitation should be strong. So there is one group of traders that were buying the stock during the accumulation period. All right. And now that we have the first wave, and now we have an invitation to buy. Now, people should be more enthusiastic to buy that stock, which means the third Elliott wave should not be the shortest wave. Because if it is the shortest wave, as it is here, all right, it doesn't make any sense at all. Because one group of traders know that they should buy. Now they signal to ordinary trader to buy, and there is no demand to buy as such. And we have this short move. It's not very encouraging. In fact, when you see that, there's a high chance that the third move will be even shorter. I mean, that the fifth wave will be even shorter. So here it is. Here it is. So all the three essential rules are all interlinked. Second wave should not cancel the first wave, because if people are very, very serious buyers, as the second wave and that wave start pulling down, those who buy first, if you see that it's coming down more, they will keep buying it. They'll keep buying it, because those are fundamental traders, these are hedge fund traders, these are institutional investors that have done their due diligence, checking the market environment, the fundamental, the management, the market share, and so on and so on. And they are happy to buy it. And they are the signature of those of first buyers is the first Elliott wave. Now prices are pulling back, becoming a bit cheaper and cheaper. If it reaches the zone between the 50% and the 61.8% level, which we call the sweet spot zone, those first buyers will continue to buy it, and more buyers will come in. Therefore, it does not make sense for the second wave to come all the way to the beginning. If it comes all the way to the beginning, it means that we have canceled the first wave, which means the market sentiment to buy the stock has been nullified. Am I speaking a proper American accent? Nullified. All right. Let's try another accent then. Okay? Has been nullified. Okay? So shouldn't cancel it. So we are saying that if they did not cancel the first wave, which means people are still willing to buy that stock, therefore it makes sense that we have an extension during the third Elliott wave. The third wave, we will prefer it to be okay, at least longer than the first wave or the fifth wave. So the third wave should not be the shortest, okay, multi-wave. Again, the second rule is stating that the fourth wave should not overlap the first wave. Why? It makes sense. All right, here we are. There was first buyers, there was second buyers, price went up, okay? Always, remember, minimum price move is free in anything, remember this, all right? So I'll share something with you which I discussed in one of my hidden channels on YouTube. I will not mention the name today. That I talk about is that whenever you have a group of people, all right, so take this from me, all right? You may disagree today, but hold it there, and maybe it will make sense later on. You have a group of people, all right? And they all criticizing you, all right? They all hate you. What you need to understand is that even though it looks to you that the whole group is criticizing you, remember this, that at least 33% of those people, all right, will not hate you forever, which means you have at least 33% of those people that can quickly join you, that will quickly stop, all right, hating you. All right, that's it. That's it. All right. So the point I'm making here is this: we are now in the third area wave. Everybody bought it. All right. There is another group. It's about okay, 3 times all the time, 3 times all the time, 3 times all the time, 3 times all the time. Minimum price move is 3. 33% of the group will not follow the rest of the group. They are independent people, and they will do that. This is my own observation. All right. Feel free to disagree. So the first buyers, second buyers are the one buying at the end of the second wave. There will be another third group trying to buy if the fundamentals are solid. That's how it goes. In fact, that has something to do with the area wave principle itself, because we talk about the first wave. So what is happening? We have the first buyers right here during the consolidation phase. Okay, buying first, they create the first wave, and then we have the second buyers here joining the first buyers, creating the third wave. That's why we have two groups buying during the third wave. That's why usually we see the third wave that is extended. But there is another group who want to buy. Those groups will come somewhere here. All right. So that's why the fourth wave should not overlap the first wave. So the point I'm making, talking about 3 and 33, is that always in the financial market, there are always 3 groups: first buyers, second buyers, and the third buyers. This you may disagree, but this is what Elliott is telling us: first buyers, second buyers, third buyers. If we do not have the third buyers, don't call it third Elliott wave. Are you with me? So what Elliott is saying to us, that the fourth wave should not overlap the first wave, is that we should have in a normal trend the third bias. So also, if the fourth area wave is overlapping the first wave, it means that all the hard work of the first group and the second group is almost cancelled. Are you with me? So the second group and the first group has created the third wave. So for my wave count here it is. This is their hard work they have done. So they push the stock all the way up here. Now, if you apply Fibonacci retracement to this session, you will see that 78% of their hard work, 70% or 78.6% of their hard work has been erased during the fourth wave. It shouldn't be. So, talking about the fourth wave should not overlap the first wave. We are saying that in any trend, we should have 3 buyers. In any bullish trend, we should have 3 group of buyers. The first buyers, the second buyer coming at the end of the second wave, and the third buyers coming at the end of the fourth wave. In a bearish trend, we should have a 3 group of sellers. The first sellers, while the second sellers coming at the end of the second wave, and the third buyers coming at the end of the fourth wave. This is critical for us so that we may have no violation of the Elliott wave rules. In fact, the 3 essential Elliott rules are interlinked. The first rule stated that the second wave should not cancel the first wave, all right, which I explained to you already, and also the fourth wave should not overlap the first wave, and also the third wave should not be the shortest wave. First, the first rule, the second rule, and the third rule are all interlinked. Am I making sense, or am I talking to myself again? So if you look carefully here, there were no third buyers. It's a violation of Elliott wave principle. It's not good. And the fourth wave has erased the work of the 2 groups. So first group and second group has created this trend. So now the fourth wave has cancelled all their hard work. More than 70% of those work has been cancelled and even went into the territory of the first bias. So not only it has erased the work of the two groups, it has also erased part of the first work of the first bias. So where were the first bias before the fourth wave is coming to their territory? So this is the territory of the first bias. Now you need to understand what's going on here so you may apply your Elliott wave rule in a practical fashion. Okay, in the financial market, what is happening is that remember this: the hedge fund, the institutional investors, the banks are the one creating the trend. If they pull out, the trend will collapse. Now, therefore, their first signature, all right, is the first wave. So they don't want the price to come back there. After that pullback, during the second wave that did not cancel it, they don't want the price to come into the range of the first wave. So you have to understand, if you are a hedge fund dealing with your client money, putting your reputation on the line, you have to have some protective or defensive measures in place. You will be completely crazy not to have any defensive measures in place when you are dealing with billion, B for Bravo, billions in the financial market. It doesn't make any sense. Can you go to bed? Can you have a nice sleep? If you don't have any defensive measures, you should have defensive and protective measures in place. So they don't want the price to come into the range here. This is their signature. Therefore, it is very, very important that the fourth wave does not come into the range of the first wave. Am I speaking too much? All right? Or am I sharing a bit too much? It's nothing confidential here, so we can talk about it. Because I want you to understand this, so you may, okay, know why Elliott was saying that the first wave should not be cancelled by the second wave, and so on and so on. There is another group of Elliott wave traders that always argue that it's normal that the second wave may come all the way to the beginning of the first wave. I talked about it last time, and the argument was that as long as the second wave did not go below the low of the first wave, it's okay. So those traders during the second wave, they just keep buying, placing their stop loss few pips below the low of the first wave, expecting that the second wave will not come below the low of the first wave. Now, personally speaking, or talking about wavecon guidelines, I find anytime I see the second wave come quite close to the beginning of the first wave, we need to put a question mark on that second wave. I'm not saying that sometimes you may have to work with that, which I showed in one video earlier on, where you will be forced to do that. But when you are doing that, put a question mark on it, because this is not a normal second wave. It's not a normal second wave, because it has almost erased the signature of the first buyers or sellers in a bearish trend. You don't want that. Okay, so looking at this chart, you can see that the fourth Elliott wave has has overlapped the first wave. So what do? Yeah, that's a very good question. We can talk about it now, yes or no. So we talk about the second wave canceling the first wave. If the second wave has cancelled the first wave, following our Elliott wave count guideline, one must restart counting wave completely. So when we start looking for a new first wave, a new second wave, and so on and so on, you start from zero. But what do you need to do when the fourth wave has overlapped, okay, the first wave? That is the question, and I will answer that question today. If the fourth wave has overlapped the first wave, we do not restart counting the wave. We look only for the new fourth wave. Now, this is the first time I'm sharing this in a public place with traders. So, and it's amazing that a trader never asked me that question. If the fourth wave has overlapped the first wave, what do you need to do? That's the $1 million question. You will look for, you will expect, you wait for a new fourth Elliott wave. You do not restart counting wave. Your first wave is still valid. Your second wave is still valid. Your third wave is still valid. Now the fourth wave has overlapped. Oops. Apology to trader because I need to hit my chest a bit. Apology to traders. So if now you have your first wave, second wave, third wave in place, but the fourth wave has overlapped the first wave, all you need to do is to wait for a new fourth wave. Very often, this is a good example that's why I'm recording this video today, is because the fourth wave is a distortion very often. If the fourth wave is a distortion, a sharp correction, especially if you are counting your wave on a higher degree, first wave of a higher degree, second wave of a higher degree, third wave of a higher degree, you will see sometime, if you're on a higher time frame like a yearly chart, you may see a sharp correction. Those sharp corrections can create Elliott wave rules violations. I'm not saying that I'm not saying that all sharp correction will definitely create Elliott wave rules violation, but sometimes those sharp correction can create Elliott wave rules violation. A sharp correction is a distortion to a certain degree. And in a financial market, remember this, whenever we have a distortion, the price will try to rectify the distortion. A vertical price move is a distortion to a certain degree. The price will try to fill that distortion. Here it is. Price will go back to the beginning of the distortion to correct the distortion before it will resume again. All right. So this is a distortion. The price will try to go back to the beginning of that distortion. But in this particular case, something has changed before, because if the fourth wave has overlapped the first wave, think of distortion. It may not be a distortion. It can be a distortion. If it is a distortion, then we will expect a correction, price rectifying the distortion, and then we look for a new fourth wave. But the example that I'm showing you today, which is a bit interesting, that's why I'm recording the video, is because this is the fourth wave that has overlapped the first wave of a higher degree. When the price was trying to rectify the distortion, did not come all the way to the starting point, which is very, very interesting. Did not come. People will say, now it's here. Now we expect the fourth wave. But surprise, surprise, the fourth wave is already here, which is a triangle. 1, 2, 3, 4, 5. A triangle. Sometimes they may say, Joel, from here, blah, blah, blah. Sometimes they may say, 1, 2, 3, 4, 5. Sometimes they may say, oh, here you see, 1, 2, 3, 4, 5. No, because the price went up trying to fill that distorted long candlestick bar on the yearly chart, couldn't reach the starting point, they start pulling back. You see here, pull back, 1, 2, 3. So it's not from here. Feel free to disagree. 1, 2, 3, 4, 5. Give precedence to the triangle, though we are expecting A, B, C, D, E. The price may ask you to wait a little bit more. So my wave count, first wave, second wave, third wave. Fourth wave has overlapped the first wave. We are looking for a new fourth wave. If there is a distortion, we'll expect the distortion to be filled first. Right? It was trying to fill that distortion. Now here it is, our new fourth wave. We are now in the fifth wave. Anytime we see a fifth wave or we label something fifth wave, we will think of what? An extension. Is this the end of the fifth wave, or will this fifth wave be extended? You can't wave on one time frame like this. You want to compare it to the higher degree wave count to see whether it makes sense. You also go into the mind of other traders to see from the viewpoint of other Elliott wave traders and also from the viewpoint of normal technical traders. This will conclude our discussion today about how to apply the Elliott wave rules precisely. The first rule stated that the second wave should not cancel the first wave, and the second rule stated that the fourth wave should not overlap the first wave. And the third rule stated that the third Elliott wave should not be the shortest impulse wave. Though there are other many rules, there's something I want to share with you today is that when we have a rule, we can deduct many things from that rule, creating many other sub-rules. Are you with me? Women are quite good of deducting something. People who have done mathematics are very good in deducting something. Though I'm saying to you, we have 3 essential Elliott wave rules. From one rule, we can deduct other sub-rules. Am I making sense? We can deduct other rules. So do not think that it's only about those 3 rules, but the implication of those 3 rules are quite wide. And those rules are interlinked. They have linked with each other. So this will conclude our discussion today about how to apply the area wave rules precisely. Before we go, I need to remind traders that when we are using the area wave theory, which other traders that have been following us for years already know exactly what I'm about to say, is that we should always separate the theory from the reality of the market. Why? One example is here. So suppose you were here, you were saying, George, you were saying that, oh, all right, this move up is correcting the distortion. And then you say, George, that the ABCDE has started from here. Okay, stay with me, all right? We're going to wrap it up soon. You say, all right, you say ABCDE. All right, George, that's what you are saying. Okay, this is what I'm saying. The reality of the market and the application of the area wave theory, the practicality. So you say, all right, okay. So there was a trend. Okay, so A, B, C, D, E. So you may say, George, your A is still overlapping the first wave. Why? That's a very good question. Now you can see the reaction here. This is a very good question. Though this, here we are, this section of the prime went a little bit fast to go below the range of the first wave, you can see that the second candlestick bar quickly went up. A trader did ask me a question one day, when the second wave got a long tail or the fourth wave got a long tail, how do we handle it? And I said to that trader, it depends on your own judgment. Will you accept it? Are you happy with it? Are you willing to work with it? Yes or no? Sometimes you will work with it. Sometimes you will discount it. So here, I prefer to discount this move because you can see what's going through the mind of other traders. The market went down quite volatile. And here it is, it went down. As it's coming down, those sellers, volatile sellers, came back again, are selling very, very fast. They didn't know that, okay, they call that the price is not going to go down anymore. And they sold it down very fast, pushing the price again a little bit below the high of the first wave. Should we discount this move? Some traders may discount it and say those traders may say, all right, I'll discount it. It's up to you. For me personally, I don't discount it because I understand what is happening here. So this is about separating the area wave theory, the area wave principle, and the application of the area wave theory for making real-time, okay, financial market decisions. If you have any question or suggestion, feel free to put in the comment section, and of course, I will be recording another video to answer your specific question. If you find this video truly useful, let us know by giving us that thumb up, alright? You think that this is another ridiculous blah 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 for more than 20 minutes, mark it down. Alright, if you think this is an essential tutorial, feel free to share it with your friend on Google+, on Twitter, and also on Facebook. Until the next time, enjoy yourself and be very happy. We are the TSTW24 traders talking about how to apply the area wave rules precisely. Happy trading to you all and speak to you soon.